The Fed is the central banking system of the United States, and its main purpose is to regulate the money supply and promote economic stability. Think of it as the bank for banks, overseeing all of the financial systems within the United States. The Fed's actions play a crucial role in shaping the financial landscape of the country and have far-reaching implications for both the stock market and your own personal finances. In this video, we're going to take an in-depth look at what the Federal Reserve is and what they do, as well as how their decisions impact our daily life, the stock market, and the global economy as a whole. If you live in a country that's not the United States, you may be asking yourself right now, why should I care what's happening on the other side of the world? Well, the reality is that in today's interconnected world, financial systems are like a giant web, and the decisions that happen in the United States can send a giant ripple throughout the entire world's economy. So if you're not from the United States, it's still good to have an understanding of what the United States Federal Reserve does and how they operate. So you can still learn something from this video, especially the segment where we dive into the global impact that the Federal Reserve has. So no matter where you're from, strap in, because this is going to be a bumpy ride. So as the United States of America grew, and with it, its economy and its impact on the rest of the world, the monetary policy grew to become even more complex. And so it became obvious that there needed to be some sort of governance and oversight and some entity to enact policies throughout the entire economic system. This was done through the Federal Reserve Act of 1933 and another act in 1935. The people who made this act decided that it would go against the checks and balances that our Constitution and our nation was founded upon, and so they decided to rule against the idea of a single central bank system and opted for a more expansive central banking network. This system consists of three key entities who serve this central banking system, which represent the United States as a whole. The first of these entities is the Federal Reserve Board of Governors. There are 7 members of the Board of Governors who are all nominated by the President and confirmed by the Senate. They can serve a term of up to 14 years. One term begins every 2 years. From the rest of the board, the President can nominate the Chair and the Vice Chair, who both serve a term of 4 years each. Within these Board of Governors, there are several committees that oversee various aspects of the nation's economy and monetary policy. These include the Committee on Consumer and Community Affairs, Economic and Monetary Affairs, Financial Stability, Federal Reserve Bank Affairs, Supervision and Regulation, a subcommittee on smaller regional and community banking, and a committee on payments, clearing, and settlement. So the Board of Governors as a whole oversees the other 2 branches of the Federal Reserve. The next entity are the Federal Reserve Banks. There are 12 reserve banks, each with their own board of directors. These reserve banks operate within their own specific geographic region of the United States. Each reserve bank's function is to gather data and information about the businesses and the needs of the local communities within their region. That information is then relayed to the other 2 legs of the Federal Reserve to help set up and determine monetary policy for the United States as a whole. These regional banks do the following. They supervise and examine state member banks. They lend to depository institutions to ensure liquidity within the United States financial system. They provide key financial services, and they examine compliance with laws by certain financial institutions. The final leg of the Fed is the Federal Open Market Committee. This is the part of the system that you hear about in the news. These are the people that set the national monetary policy. The Open Market Committee make decisions about the conduct of market operations, which affects the federal funds rate or the federal interest rate. The committee also controls the size of the Federal Reserve asset holdings and communicates the changes, policy updates, news, and economic outlooks with the public. The Market Committee directs the operations that are enacted by the Federal Reserve in our foreign exchange, so they direct our monetary relationships with other countries. There are 12 voting members of the open market community, which includes the 7 members of the Board of Governors and 5 of the Reserve Bank presidents who rotate in and out each year, except for the Reserve Bank in New York. So now that you have an understanding of what the Federal Reserve looks like and how they're run, what do their monetary policy actions look like, and how would they affect somebody like me or you? So the big term that we keep throwing around is monetary policy. The Federal Reserve controls the money supply and interest rates in the economy. That is what we mean by monetary policy. It uses various tools to influence borrowing, spending, and investment with the ultimate goal of keeping inflation in check and maintaining steady economic growth. The Fed's ultimate goal is to maintain a stable economy. As we know from the past few years, and even past few decades, this is a very challenging task. The Fed aims to prevent and navigate financial crisis by monitoring and addressing risks in the financial system. One of the most common ways that they go about doing this is by increasing or decreasing the federal government lending interest rates. The way that an interest rate for a loan is determined on any type of lending, whether your credit card, your home loan, or your auto loan, it begins with a base rate, and then it adds the inherent risk of lending that money to that specific person, which is dependent on credit score and other factors. The Federal Reserve sets this base rate, which is why their monetary policy is so powerful. Too much inflation is bad for the economy. To get ahead of this, the Federal Reserve can change their monetary policy, specifically setting higher interest rates. By setting higher interest rates, it raises the cost of borrowing money. This leads to banks, companies, and regular people like us to be less willing to spend money. The less money that is spent, the economy then cools down, slows down, and inflation will go down with it. However, sometimes inflation is a good thing. If the economy has become stagnant or is in a depression, then the Federal Reserve may lower interest rates drastically. This has the opposite effect of what we discussed previously. By lowering the cost of lending, banks, businesses, and regular people are more willing to spend and borrow money to spend, which stimulates the economy and helps start up its growth. To be more specific, you will feel the effect of the Fed's monetary interest rate decisions in the following ways. When the Fed lowers interest rates, it becomes cheaper to borrow money for things like buying a home or financing a car. Conversely, higher interest rates can lead to increased borrowing costs, making loans and mortgages more expensive. Because of these interest rate decisions that the Fed makes, the real estate market is highly affected by these decisions. If interest rates are raised, this causes mortgage loans to be more expensive with higher interest rates, therefore costing you more money to borrow the money required to buy a house. Now, this type of difficulty in borrowing may cause the demand in the housing market to cool, which is actually the intention of the Fed. Cooling demand reduces spending and slows inflation. If you are looking for a house, it may actually be easier to find one in this market, but harder to afford it. Although once interest rates are lowered, you could use the lower interest rates and refinance your mortgage. If interest rates are in a low position, then the opposite happens. The cost of borrowing money to buy the house is much cheaper. This causes people to be more willing to borrow money, take out a mortgage to buy a house, which moves the demand up drastically, making it harder to actually find a house to buy. And it also makes the cost of the homes themselves much higher to match that demand. Again, this is planned by the Fed to increase inflation and stimulate the economy's growth. These practical examples also apply to any type of consumer loan, such as an auto loan or a credit card loan. The higher the interest rates that have been set by the Fed are, the higher the interest rate you will pay on new types of loans made within that period or on variable rate loans. Lower interest rates may result in lower returns on savings accounts and bonds, which may prompt some individuals to seek higher returns in riskier assets like stocks. On the other hand, higher interest rates can make saving more attractive, but they may also lead to potential declines in stock prices and the stock market. This means that the Fed can use interest rates to stimulate the stock market or to slow it down to prevent a recession or a burst in the market bubble. Some practical advice: pay attention to the news and what the Fed is doing with interest rates. If interest rates are high, such as above 4%, you may want to consider more investments that produce interest, such as a CD or a bond, or leaving a balance of cash that will just collect interest over time. This probably also means the stock market may be more volatile and risky. Unless you can guarantee a higher percentage yield than the interest rates that you could receive, then interest is the way to go. If the Fed is lowering interest rates, then this signals that stocks will start to become better investments, while simultaneously, new interest earning investments like bonds or CDs will begin to have lower and lower interest yields. Chances are these yields will be much less than what you could get in the stock market. So unless you are completely intolerable of risk, you should move away from bonds and CDs at this time. The Fed aims to maintain stable inflation, which affects the purchasing power of money. Too much inflation erodes the value of money, while too little can hinder economic growth. Some level of inflation is inevitable and even a good thing. Usually an inflation rate of about 2 to 3% is normal. You feel the inflation when you buy regular items and they are suddenly more expensive. And everywhere you go, prices have gone up. Up to this point, we have only been discussing one of the Federal Reserve's jobs. Aside from maintaining stable prices and economic growth, they are also focused on maintaining inflation as it pertains to employment, so that the American people have jobs. As with maintaining stable prices, using interest rates and the amount of money in circulation are used to do this. Surprisingly, these tools have a huge effect on how easy it is to find a job. Imagine interest rates as a remote control for the economy. When things are going well and lots of people have jobs, the Federal Reserve might press the button to raise interest rates. This makes borrowing money a bit more expensive, which can make people and businesses slow down their spending, including spending on employment. While this stops prices from going too high, it also stops employment from getting too good. On the flip side, when the economy is in a tough spot and there's not many jobs to go around, the Federal Reserve might choose that point to lower interest rates. This makes borrowing money cheaper, and it encourages people and businesses to spend more, including spending on labor. It gives a boost to the economy when it's in a rut, helping to create more job opportunities for people like me and you. But wait, there's even more. So the Federal Reserve also controls the amount of money that's moving around. Think of it like pouring water into a river. When there's more money around, people spend more money. Businesses grow, and that means more jobs. However, they have to be careful not to pour too much money in. It's like adding too much water to the river and causing it to flood. That flood can show up as prices going up way too fast, making it harder for regular folks to afford things. So with all of these different challenges to balance while also maintaining inflation, you can see how difficult each decision that the Fed comes to is to make. While its primary goal is to manage the United States economy, the Fed's decisions also reverberate across the entire globe. One way that the Fed influences the global stage is through its monetary policy decisions. As we've talked about, they can adjust interest rates, and the Fed can either stimulate borrowing and spending or tap the brakes on the economy. When the Fed raises interest rates, it becomes more expensive to borrow money within the United States. This can slow down spending and investments, not just in the United States, but also internationally. Imagine if the US starts paying higher interest rates on its debt. That can lead to a global shift in the capital flows. Now let's talk about international trade and the exchange rates. When the Fed changes interest rates, it can also affect the value of the US dollar. A higher interest rate can attract foreign investors looking for better returns on their investments, which can lead to an increase in the demand for US dollars. This stronger dollar can impact the competitiveness of U.S. exports in the global market, potentially slowing down international trade. Further, changes in exchange rates can affect the profitability of multinational companies. If a U.S. company earns a significant portion of its revenue in international markets, then a stronger dollar can actually reduce their earnings when converting them back to US dollars. This can impact the company's stock price and, in turn, influence investment opportunities for that company. Now, let's connect all these dots to the job markets and investment opportunities within the global scale. When the U.S. economy experiences changes due to the Federal Reserve's decisions, it has a ripple effect on the economies worldwide. If the U.S. economy slows down, it can lead to reduced demand for goods and services globally. This, in turn, can impact job markets in other countries, especially those closely tied to U.S. through their trade relations. Investment opportunities can also be influenced by the Fed's actions. As interest rates change, investors might shift their portfolios to adapt to the new conditions. For instance, when interest rates rise in the US, other countries might see an outflow of capital as investors seek higher returns in the US. This movement of capital can impact asset prices and investment trends on a global scale. To sum it all up, the Federal Reserve's decisions are like stones dropped into a pond, creating waves that stretch across continents. The global financial ecosystem is intricately interconnected, and changes in the US can trigger chain reactions that touch everything from exchange rates and trade to job market and investment choices. So even if you're not in the US, keeping an eye on the Fed's moves can help you navigate the constantly changing world of personal finance and investment, especially when looking at buying investment opportunities from the United States. Since the Federal Reserve is part of the government, it is open to the very same sorts of criticisms and challenges from the American people. One major criticism revolves around the transparency and independence of the Federal Reserve. Some people argue that the Fed's decision-making process is not as transparent as it should be. Meetings aren't always open to the public, leaving some feeling left in the dark about the factors that are influencing our economy and impacting our daily lives. As we've discussed, these decisions have such a huge impact on the American people. Even a slight interest rate change can change the price of gas or the price of groceries. Additionally, there's the question of the Fed's independence. People worry that political pressures might influence the Fed's actions, potentially steering their policies away from the best economic interest towards the best political party interest. It's important to recognize these concerns and to advocate for increased transparency in safeguarding the Fed's independence. By doing so, we ensure that the decisions made by the Fed are in the best interest of the economy and ultimately your financial well-being. Similarly, your elected officials, such as President of the United States, are the people who choose who sit in these seats. So indirectly, you have a small say in who makes these decisions that will impact your financial well-being. Another topic of intense debate is the actual effectiveness of the Federal Reserve's policies. On one side, you have those who praise the Fed's monetary policies, like setting interest rates and influencing money supply. They argue that these tools play a crucial role in stabilizing the economy, especially in times of very volatile market situations. For instance, in times of crisis, like the COVID-19 pandemic, the Fed can step in to prevent financial meltdowns and keep things afloat. But of course, there's another camp with differing viewpoints. They emphasize the potential downside, like the risk of inflation or asset bubbles caused by the Fed's actions. It's essential to recognize that there are valid arguments on both sides of whether or not the Fed is effective at their job. By understanding these different perspectives, you can better navigate the ever-changing financial landscape and adapt your own personal investing strategies accordingly. Lastly, let's talk about why it's very crucial for you to critically evaluate the role of the Federal Reserve in shaping your financial reality. Understanding how the Fed's policies affect interest rates, job opportunities, and even inflation can give you the upper hand in planning your finances and planning your investments. Think about it. How do the fluctuations in interest rates impact your mortgage or your investments? How does the Fed's response to a specific economic situation indicate the influence of job markets and prices? These are the questions that you need to constantly be asking every time you see a headline about the Federal Reserve. By critically evaluating the Fed's role and critically evaluating the Fed's decisions and actions, you become an empowered participant in conversations about the economy and the economic policies that directly impact your financial choices and your financial situation. The Federal Reserve is a critical player in the economic game. By addressing their criticisms, understanding their different viewpoints, and encouraging your critical evaluation of their choices, you are better equipped to navigate financial waters. So in conclusion, understanding the Federal Reserve's role is essential for anyone aiming to make informed financial decisions. The Fed's impact stretches far beyond its borders, influencing economics worldwide through its own monetary policy decisions and its interest rate adjustments. By grasping the structure of the Federal Reserve, its monetary policy tools, and how those decisions affect you, you gain the upper hand in your financial journey. Keep a close eye on interest rate changes. Higher rates mean borrowing costs increase, affecting your mortgages, your loans, and your investments. If you're planning on buying a house or buying a car or using a credit card, you need to keep up with interest rates. Lower rates encourage spending, potentially boosting the economy. Pay attention to how these changes impact the real estate and the investment markets, and adjust your strategies in each accordingly. Always remember that the Federal Reserve's actions have ripple effects on global economies as well. Exchange rates, trade relationships, job markets, and investments all experience shifts based on their decisions. This interconnectedness means that even if you're not in the US, staying informed about the Fed's decisions empowers you as well to make good financial investment decisions. Lastly, as with any institution, the Federal Reserve has its challenges and its criticisms. And keep in mind, they are the government, so they will make mistakes even if they won't admit that they made mistakes. Advocating for transparency, understanding the different viewpoints of the Fed, and critically evaluating their role ensures that you can make decisions that align with your financial goals, and you can advocate for better improving the Federal Reserve. So whether you're a seasoned investor or just starting your financial journey, the Federal Reserve's impact is something you can't afford to overlook. Subscribe for more insightful content, stay informed, and remember, in the realm of personal finance, knowledge truly is your most valuable asset. Thank you for watching this video, and I'll see you in the next one.